Profit is revenue minus expenses. And a business has a lot of expenses, usually grouped together into 4 categories. Each time an additional group of expenses is subtracted from revenue, a new profit metric emerges, providing insight into the financial health of a company. You'll often hear company executives talk about revenue, gross profit, operating profit, and net profit. To help illustrate where these profit metrics appear in the financials and how we calculate them, let's take a look at a simple income statement. At the top of the statement, you'll find revenue, sometimes called sales. Revenue is generated from the company's sales of products or services. It's the reason they're in business. Then comes the first set of expenses, the cost of goods sold. This is the amount of money it costs the company to produce and deliver the products or services. Subtracting the cost of a product or service from revenue gives us gross profit. This is a useful measure for companies because it tells them how much money they are earning on the products or services they sell. A company wants to make as much as possible from each product sold, so it will look at gross profit when determining pricing, product mix, sales availability, and budgeting. After calculating gross profit, there's a few additional expenses from running the business. These line items are often referred to as operating expenses and would include salary, rent, sales and marketing, IT, and so on. Subtracting out these expenses from gross profit, companies report an operating profit. And this metric is rather important. Most, if not all, industries include operating profit as a key indicator of a company's efficiency. Think about it. All expenses above this line are expenses from a business's core operations, producing a product or service, and paying to keep the company running. Employees can help reduce these expenses as they work day to day in the core operations, thus resulting in a higher operating profit. This is a profitability metric that employees can impact. Sometimes you'll hear executives refer to operating profit as EBIT, E-B-I-T, which stands for earnings before interest and taxes. Companies may take out business loans in order to maintain operations. Interest expenses are the cost of interest charged on those loans. Further, companies pay out taxes to local, state, and federal institutions. These are fees based on profitability in order to maintain operations. Once all expenses have been deducted, a company reports its net profit. This is found toward the bottom of the income statement and often referred to as the bottom line. When business people talk about how profitable a company is, they are usually referring to net profit, the profitability reported after all expenses have been accounted for. Company leaders will communicate profitability in both currency amounts and as percentages. When it's a currency amount, the term profit is used. When shared as a percentage, the word margin is used. It's simply taking the amount of profit for that metric divided by the amount of revenue to express that profitability metric as a percentage of revenue. So you'll often hear operating profit last year was $1.49 million, so our operating margin was 18%. Margins tell us how efficiently a company is turning revenue into profit. For instance, if the net profit margin is 10%, then 10 cents out of every dollar received is profit. Even though one company may have lower profit in dollars than another, its margin might be significantly higher. This indicates a well-managed business that generates more profit from every dollar of revenue. Managers are constantly striving to improve margins. Companies use margin to compare their performance with peers throughout their industry and the stock market in general. Historically, the average gross profit margin from the S&P 500 is around 35%, operating margin of 15%, and net profit margin of about 10%. You'll find some companies have higher net profit margin than 10% and some have lower. It all depends on the line of business that you're in. Higher margin companies usually innovate new products and services, selling something exclusive, where lower margin companies sell commodities. Think of it this way. You don't have to buy your gas from ExxonMobil, and you don't have to buy your milk from Walmart. But can you buy an iMac from someone other than Apple? Companies selling something unique or exclusive can charge more than those companies selling products that are readily available from multiple vendors. Remember this, if you're not unique, you better be cheap.